Hello and welcome everyone. My name's Angus. Thank you for joining me today to work through this webinar. If you're watching this video, you're probably down here in Victoria, part of the building and construction industry, and you've heard about some of the new changes that are coming into force over the coming months and years. And the purpose of today really is to give you an overview of those, give you my take on it, what I think we need to do, really focusing on the financial reporting aspects that are going to come into play for our domestic builders down here in Victoria. And look, the way I see this is an opportunity or a catalyst to implement some real financial structure and framework to our business to help us across the board, margin improvement, growing the business, and meeting these new requirements that we're going to have to do anyway. And so I know you're short on time. I will make this worth your while. Thank you for joining. Let's get into it. So a quick agenda for the session today. What's changing? Why is it changing? What do we got to look out for? What are the new minimum financial requirements that you're going to have to meet? And as part of that, the disclosures around those, or the notification, the ongoing reporting, and the timeline for the implementation and for you depending on the size of your business. And then importantly, what should we do about this? We do not want to bury our heads in the sand. We want to get on top of this, get in front of it, so that by the time these new rules kick in, we are all across them and there's no problems. And again, that's what I see as a huge opportunity down here. All right, some background. So you've probably seen some headlines or some emails, some news articles even, about this new Building and Plumbing Commission, the BPC. This is the new regulator that's going to be administering this space down here in Victoria, and it's really combining a few different government departments or regulators right now under the one roof. Now, your licensing and regulation with the Victorian Building Authority, the VBA, that's going to be coming under this new regulator. So is the disputes and the disputes resolution process. And importantly as well, our home warranty insurance, our domestic building insurance, also now under the roof of this new Building and Plumbing Commission. Key element of this is that there's now going to be these minimum financial requirements introduced for our domestic builders. And so what that means is this new regulator is actually going to have direct visibility of the financials of your business. So how's your balance sheet looking? They're going to know because we're going to have to report to them. So this is a huge change down here. Now this new framework is really quite heavily modelled off the current Queensland regime, which has been in place for a number of years now. So any Queensland viewers, you'd be familiar with this. And they're essentially taking that model and bringing it down here to Victoria. And just a note there, again, look, this regulator is going to affect the whole industry, but in terms of these minimum financial requirements, the big impact is anyone with a domestic building license. There's going to be numerous licenses that fall within that umbrella, but if you're a home builder or anyone with one of those domestic building licenses, this will have a big impact on you and your business. Okay, let's think about why the change, okay? In their words, they're improving trust, oversight, and promoting capability in the sector. You would know there's been a lot of turmoil in the space over recent years, especially. Some big builders have, gone bankrupt or become insolvent, and that's left a lot of consumers, with half-built homes and big problems in the sector. And so there's a lot of pressure from the consumers to bring in some new regulation to manage this risk. And as you probably know, building and construction companies make up a huge percentage of insolvencies, so businesses that go belly up and run out of money. And the whole point of these laws is to protect those consumers, protect the subcontractors that are engaging with these builders, and provide some financial oversight. Now, I appreciate that everyone's going to have their own take on this. Yes, it's more red tape, it's more headache, it's more reporting. There's going to be some things that we need to do to keep compliant. But for the vast majority of builders out there that are doing the right thing and doing a great job, I do not see this as a bad thing. You know, if we tick the boxes, we should be able to sail through these tests no problem with the right help and the right systems. And it means that, you know, those few dodgy operators might get picked up earlier on and avoid some issues. And for the vast majority of us that are doing a great job, I actually see this as a bit of an opportunity and not necessarily a bad thing. But look, regardless of how you feel about it personally, it's here, so we've got to do something to deal with it. Now, a key component of this new plan, or the new changes, is the introduction of this 3-tiered system. And again, it's similar to the way they've done it up in Queensland with the different license classes. But here we've got 3 key tiers, okay? So if you're a small builder, you're tier 1, medium builder, tier 2, and you're a large builder, you fall into that tier 3. I'm going to go through this in more detail in a moment, but the easiest way to think about this is thinking about your turnover, so your gross sales, not your profit, but your revenue. If your turnover is under $1 million, you're going to be a tier 1 builder. And in that case, you typically, your licensing, you'll be doing a self-declaration or certification, and you won't need too much accountant prepared information, or you know, those more stringent reporting requirements. If you're a medium builder, this is a huge category. So from turnover $1 million up to $30 million, this is going to capture a massive, massive part of the market. If we fall into this cap, this tier, we will need reports, you know, prepared by your accountant and signed off, and you know, that's just adds an extra layer. But the really sort of the more stringent one at the moment, again, as we go up in the tiers, it becomes a bit more stringent. But if we're turning over $30 million, we're a large builder. At that point, you might have a bit more of a sophisticated, you know, internal finance function. You might have some internal finance people. And so for you guys, you might be able to do this without too much headache. I will say right now, the laws are not set in stone yet. They're still in the consultation phase, and I'll go through that in a moment. But a key point I'd like to make is these figures aren't yet set in stone. There's been a lot of comments about that $1 million total. It's probably a bit low, and there's been some feedback saying, hey, look, it should probably, you know, if tier 1 builders came up to $2 million instead of $1 million, that might be a bit more appropriate. Get a lot more smaller builders into that simpler category. So there's been some feedback around that. Not set in stone yet, but these are the current figures. There's also a bit of a question as to around the extent to which tier 2 builders will have to produce the more complicated financial reports called general purpose financial statements. There's a hope amongst us accountants, and we're confident that this will happen, hopefully, that our tier 2 builders, yes, you're definitely going to have to be providing accountant prepared statements, but there's a hope that they're not going to have to be the full general purpose statements that, you know, your listed businesses do. So that's the hope, and hopefully during the feedback and the consultation process, they can come to that arrangement. But at the moment, just thinking about this, 3 tiers, and when you think about your business, where are you going to sit is going to determine what you have to do. When we talk about these minimum financial requirements, what are we actually talking about? The first big one here is net tangible assets. I'm going to go through a definition of that in just a moment. But the key point here is that revenue must not exceed 20 times our net tangible assets. Put that another way, our net tangible assets of the business must represent at least 5% of our annual revenue. So the regulator here is saying, hey, we've got enough assets on the books to support the turnover. Obviously, as the turnover goes up, the risk and the insurance risk sort of goes up. So we need more assets to support that. The other key test there is our current ratio. And this here is comparing our current assets and our current liabilities, and essentially asking the question, all right, do we have enough cash either in the bank or coming in the door soon to pay the bills that are going to be due in the next 12 months. And so it's a real test of our liquidity, and it's a bit of an indicator as to whether a business is financially healthy or whether there might be some risks that they might be trading insolvently. And then the third sort of requirement here is just our ongoing reporting and monitoring. We're going to have to prepare and submit an annual financial report to the regulator. That's a once-a-year job. We also, if we're tier 2 or 3, are going to have to produce quarterly management accounts. And we might not necessarily have to submit them, but they have to be available upon request within at least 14 days. Why might we have to do that? If you are applying for a new license, perhaps, and you needed to upgrade, if there was an audit and the new BPC wanted to audit our books, we would have to provide that. And another, example of maybe an unfortunate situation might be if we just happen to miss one of our bills for a subcontractor or a trade, and they actually reported us to the regulator might have to come and investigate that. And as part of that, they might ask for our quarterly management reports for the last quarter. So we need to be doing these. There's a few other pretty strict reporting requirements. And for example, if we're going to exceed our maximum revenue under our current license, 7 days notice we have to give. If our net tangible assets decrease beyond a certain limit, we've only got 30 days worth of notice. And if our current ratio is less than 1, 10 days notice we have to give them, which is not a lot of time. And I'm going to go through all these elements in a moment, but there has been some comments around those dates. Again, in the feedback phase, master builders and a few other accounting bodies and firms have sort of, come out and said, all right, are these numbers realistic? Is it realistic to know within 10 days? Maybe we're going to be able to push that back to, monthly or a certain amount of days after month end, which might be a bit more appropriate. But in any case, we're still going to want to know these figures monthly. And so the question is, do you know these figures at any given time? I think for a lot of those tier 2 medium builders, the answer is probably no. You might know it at year end when you do the tax and the financials. Maybe quarterly, if you do a quarterly check, maybe. I think a lot of people probably aren't doing that as well. Or maybe once a year if you're doing your insurances or doing the actual license application. But the key thing is we have to know these figures at all times, because A, we have to comply with these requirements, and B, they could pick us out of the lineup and ask for our reports at any one time. Okay. The other one that I don't have on the slide here is just the overarching requirement to be solvent. So the definition there is, can we pay our debts as and when they fall due? And so we've always got to be solvent. Before we go down this rabbit hole of net tangible assets any further, let's just pause here. So we've all got a bit of an understanding of what I'm talking about when I say this. So when we think about assets of our business, there's a few sort of buckets here. First one here is our current assets. That's typically anything that we're going to convert into cash within a 12-month period. So if we think about that, cash in the bank, obviously that's a current asset. Our receivables, so the progress claims or the invoices that our customers owe to us, that's a current asset. If they're under 180 days due, we get to include 100% of them in the calculation. If they're overdue by more than 180 days, we only get to include half of them because, odds are we're not going to be able to collect all those monies. They might be bad debts, and the regulator knows that. I would say, if we've got heaps of outstanding invoices over 180 days, we've got some other problems in our systems that we need to iron out. That would be a pretty big indicator. And then work in progress, WIP. I'm going to go through this in a lot of detail as a big chunk of this webinar, so let's just keep that in mind. Non-current assets, this is everything else that's not going to turn into cash within 12 months. And so typically you're going to be thinking about your plant and equipment, your motor vehicles. Those are going to be the big ones on your business's balance sheet. And then there are other assets that we can include, like real property, so real estate, your share investment portfolio, all these other assets. But obviously we don't want to have these in our trading entity for risk management purposes, and we don't want these to be available to the regulator if something goes wrong. So the whole idea is we use the business to earn cash and generate generate income, and then we build those assets outside of the business so they're safe and protected from risk. So we do not want to be putting these assets up for grabs. So really we want to be relying on purely the business assets in the operating business, okay? There are some assets that are excluded from these tests. And first of all is intangibles. Now, when we say net tangible assets, that's stuff we can touch and feel and see, and we can see the cash in the bank account. If you bought a business, for example, you might have a line on your balance sheet that says goodwill, and that's the sort of the reputation, the trade names, all those intangible things that we can't touch, but there's a value to the business there. We're not allowed to include those in these tests. Other things we're not allowed to include, like cryptocurrencies, receivables over a year old. Odds are we're never going to be able to collect them if they're that old. So again, we've probably got other problems going on. And trust assets to be phased out over 4 years. If we're operating out of a trading trust, we do need to think about restructuring. I'll touch on that a bit later. There are obviously other assets here. Some other excluded assets would be recreational vehicles or unlicensed vehicles, household goods and personal items, stuff like that. Again, we never want to be dealing with this anyway. We really want to just be dealing with the business assets. And then loans to and from shareholders or associated entities. I will touch on that a little bit later. Often these are going to be excluded assets as well. So really, we're really thinking about our current assets and our plant equipment and vehicles. And when we say net assets, that's always assets minus liabilities equals our net assets. So we're going to add up all our assets, and then we're taking away liabilities. That might be trade payables that we owe to suppliers and subcontractors. That might be our GST and our BAS and super, income tax, credit cards, vehicle loans, all those typical debts of the business. We got to subtract them off. And what we're left with is our net assets. And again, as I was saying, that net assets along the bottom here supports our maximum turnover. And so with that, if we've got $50,000 of net assets, we're a small builder, we can turn over $1 million under the new rules. As our assets grow along the bottom, we can turn over more and more, but it's always going to be tied to a ratio of 20. So for example, if we've got $1 million of net assets, we can turn over $20 million for the year under the proposed laws. And just some comments around this. As you can see, the way they've written it, it's an annual income cap for the financial year, rather than like an open job limit or a rolling cap that you might see in New South Wales or other jurisdictions. And so there have been some comments around this from master builders and a few others around, hey, is this annual cap appropriate? Or should it be more like a rolling or an open job limit? Now, I suspect they're going to be sticking with the annual cap, but we're just going to have to wait for the final legislation to come out. But as you can see here, it's always going to be a question of us. How well we can show our assets on our balance sheet will determine how much we can turn over. And I will just say, just because we enter this tier 2 category doesn't mean that we can automatically turn over up to $30 million. It's always going to be tied back. If we've got $1 million of assets, we're going to be capped at 20, and so on. Okay, if we've got $100,000 of assets, net assets, yes, we're a tier 2 builder, but we can only turn over $2 million. We can't turn over 30. Okay, so even though you're going to be in this tier 2 section or tier 3 section, you would still be having to upgrade your license if you want to move up the turnover, even within the category, if that makes sense. Okay, quick touch on a current ratio. Are we in danger? This one here really means, can we pay our bills when they fall due? And this is all short-term cash-related items. So let's think about a simple example of our balance sheet. What are our current assets? We've got $80,000 in the bank. We've got receivables of 100K, so that means we've put out progress claims or invoices and we're waiting for the money to come back, but it should be here in a week or next month. So we know that's going to come in. The missing piece of the puzzle is our WIP calculation, work in progress. Going to go into that in a minute. But often, if you just run a balance sheet off of zero, it's not going to show WIP because we have to sit down and calculate it at the end of the month. We have to track our jobs and work it out. And so the problem is we can't just print out our zero report and give it to the regulator. We need to put a structure in place. But let's just say we've got 180 grand worth of current assets. And our liabilities, we've got 110,000 of payables that we owe for materials accounts and for subcontractors, that sort of thing. Other common ones, GST, super, pay-as-you-go withholding, we might have 60,000. And then credit cards of 20,000. We might do the vehicles or the materials on a credit card sometimes. And so assets 180, liabilities 190. We've got a ratio there of 0.95. So that's in the red. That's under 1, which is the minimum. So the minimum is we have at least enough current assets as current liabilities, ideally more. If we're under 1, we've got a problem in the eyes of the regulator. So that's the baseline we need to start working above. And the work in progress is really going to be a big piece to solve that puzzle. Let's just touch on the timeline. Right now, late March, they've released the draft legislation. It's been out for comments, and I think the due date for comments was the 18th of March, which was just last week. So master builders, a few other accounting firms, bodies like that have read it and put some comments back to the regulator, and they're going to review those and hopefully make some changes and redraft it over the coming months. They're going to report back in June, and from 1st of July 2026, these new rules will be in place. Now, if you're a new builder looking to register after July, you're going to be straight into these new rules and you're going to have to comply with them immediately. If, however, you've currently got a building license, we do have some time. There's this phase-in grace period where we've got some time to switch to the new program. And so if we're a tier 1 small builder, we've got until July 2028. Tier 2 medium builder, we've got until March 2028. And tier 3 large builder, we've got until November 2027. So you might think, hey, we've got 2 years here, we don't need to worry. My advice and my recommendation is let's make some changes now, get everything set up so that by the time this happens, we're well across everything. It's not this sudden change that's stressing us out and causing sleepless nights. We already know well in advance where we're going to sit in the tiers, what turnover we need, what assets we need. Our balance sheet's going to be all sorted out, and we're going to glide through the changes. So we do have some time, but again, depending on your size, and again, depending on what you need to do, you might need to upgrade or you might be restructuring, and so even before 2028, you might still need to come in and do this reporting. If you're operating out of a trust, you need to start thinking now how the new laws are written. They're going to phase out trust assets, and so you might be needing to move to a company. And so the key thing I'm talking about today is, all right, we've got these new laws, they're coming into place. We're going to need a plan. We're going to need some structure. And the really cool thing, or the great thing, I think, is that we really need this structure in place to satisfy the laws, but I think it's a great opportunity to use that structure to also improve our business. You might be able to now track margins a little bit better once we do these things. You might be able to grow the business. I think if you're a $2 million business and you're trying to become a $5 million business, there's really this sticking point where if we don't have these good systems in place, we're not going to get there. It's too chaotic. There's not enough processes in place to do that. And again, we need to be managing those margins, and I'll go through a bit of a framework on how to do that. But that's the key essence. I think we've got to put a plan in place. Because if you can sit here today and say, look, I know these numbers top to bottom, no problem, I'm all across this, then you are doing an awesome job. But I think you're probably one of the few, not the many. I think if a lot of us had to sit down today and work out our current ratio and our net assets and our work in progress, we would be scratching our heads. So that's what we've got to think about. And how do we do that? What are the building blocks? At the bottom there, our business structure, companies, trusts, thinking about asset protection and tax. That's the base level that sets us up for success. The next key key item there is our bookkeeping and our tech stack and our job costing. We have to get this right in order to move up the chain. I think there are a lot of great builders and great tradies out there that get stuck at this level actually, and the bookkeeping's incorrect and it's chaotic. We don't have a good system in place, and then we can never move beyond. And so I'm going to go through these as well. That next level there, once we've got that great bookkeeping system in place, we can really get some financial discipline in the business. And for me, what I think that's implementing a nice little month-end process so that every month we're checking our numbers. We've got some formal sort of figures there we can compare against our estimates and see how we went. And that can really help us manage that cash flow, manage those profits. And a big part of that is the WIP reporting. Once we've done all that, we get the reward, the end result, and that is some clarity. That means we can actually use some forecasts and some budgets as a way to set goals and track our progress against them, which is huge. And we can work on improving the margins and managing the business a bit better. Key point I would make here is all the big guys, all the pros, all the big businesses and the really experienced guys are doing this. They're up here and they're reaping the rewards. If we're stuck down here, I really think we should say, all right, if the pros are doing this, let's give it a crack ourselves on a smaller scale, on a scale that's appropriate to our business. And you might be surprised how simple we can make this, and we really get some great benefits out of it. So let's go through these one by one. And the first one here, I'm just going to touch on very quickly. Okay, not the focus of today. But when we're setting up our operating structure, and that's thinking about, all right, we're operating our company here. It's got the risk, it's got the license, it's doing it's got the contract with the customer. Maybe we've got, if we're dealing with a bit bigger business, we've got maybe a separate asset holding company. Maybe we're trying to do some property development on the side as well. Maybe we've got some good profits and we've set up this bucket company to bank some of those profits and build some wealth outside of the business. Maybe we're owning property here or doing shares or something like that. And we're using that trust to split out the profits and manage the business. Factors to consider here: tax, obviously a big one, asset protection, risk management, keeping the license safe, keeping our assets safe, succession planning for some business owners, multi-generational family businesses. You'd be thinking about how do we pass control over when the time is ready, and the cost and complexity. This is just an example picture of one business. That's a fairly sort of fairly sizable or complex business. And so for you, it might be a lot simpler. Or if you're on the bigger end of town, it might be more complex again. And again, the new MFR requirements are going to impact our structure to a certain point. We've got to make sure we've got enough net assets in our license holding entity to meet those requirements. And that might, we might be thinking about, all right, do we pay out those profits or do we retain them in the company to satisfy our license? Things like that. Big one here is the bookkeeping. Now, there are a few elements to this, and I would really recommend we get a few key apps in place. There are plenty of options, but as long as we've got some core functions that are being fulfilled by the bookkeeping system, I think it's a huge win. And they're talking to each other. We're not entering data into one and then re-entering it into another. They're actually all linked up and communicating much more efficient. We're not chasing paper. And we're also valuing our time as business owners. You might not be doing all the bookkeeping, but you might have a bookkeeper, you might have a couple finance people in the team, might be your better half doing the bookkeeping. Whoever it is, we want to value our time and make this as efficient as possible. So the core sort of software at the center of that flywheel there is going to be our accounting package. I use Xero. I recommend it to almost anyone that I work with. There are some other options out there, MyObs, QuickBooks, etc. But Xero is typically going to be your best one. And one of the reasons why is A, it's easy to use, but B, it actually connects to a lot of other apps fairly easily. The big one there is going to be something to capture our receipts and documents, such as Dext or HubDoc maybe. Xero does do this to a certain extent on its own, but there's a lot more functionality and flexibility if we use a separate add-on. Yes, it's a few bucks a month in a software subscription, but the time saving and the ease and the flow that it creates is just enormous. Our bills, our invoices, our purchase orders, they're all going through Dext, syncing up to Xero, syncing up to our job management system. If we go and fill up at the fuel station, we snap a quick picture of the receipt, we can throw it out, it feeds straight into Xero, we never have to see it again. And all our supplier bills are captured in there. Just once we've got the document. If we ever get audited, it's all in there. We don't have to have, boxes of receipts. And also, it obviously just helps us manage and measure our profit, and I'll explain that. Another big one here is a job management system, a project management system, or an estimating system, or a job costing system. All these sort of names more or less mean the same thing. And there's multiple on the market, and Build Exact is just one of them. And what this is, we're going to set up our individual projects or individual jobs in Build Exact, and we're going to be listing out all the different elements or stages or components of that job. And you might have your electrical, your plumbing, all your different phases and costs in there, your labor components as well. And we're going to be tracking the estimated costs to the actual costs, checking the variance. Were we under, were we over, what went wrong, what went right? And that's a huge piece we need to be able to learn from. And the key thing is we can't improve anything if we don't measure it. So we need to be tracking our gross profit per job. This is huge. And if we know that on that particular job we were supposed to make $100,000 or a 22% margin, but something went wrong, there were delays, there were overruns, there were material price lists that were incorrect, there was a subcontractor that we had lined up, but they dropped out, we had to replace them at a higher cost. All of these components, maybe there are variations that the owners pushed through. Do we have a contract in place to manage those variations? Make sure it's on paper before we do it. All of these elements are going to throw our profit out, and so we've always come in with a plan. Rarely are we going to end with it, end right on the dot on the dollar. But we need to be learning from these things, what went wrong and what went right, and we can't do that unless we measure per job. And the other key element we have to measure is our labor. We're always going to be estimating the labor for the job, but are we actually tracking it and allocating it to the job so that once we finish or at the end of the month, halfway through, all throughout that job process, do we know if our labor is on track or are we over? Massive component. And so you might have something like Deputy or another app in here that's sort of doing our timesheets and our labor tracking with our staff. Okay, and so the key point here, bookkeeping is the foundation. Without it, we can go no further. The rest of this webinar is not going to help unless we get this stuff right. So, big component. The next really big component for builders is our work in progress, our WIP. And you might be familiar with this. If you're not, it's okay. Plenty of people aren't across this to the level that I think they should be, and that's so fine. That's what we're here to help with. And so, let's just think about our game. Payments are lumpy. We're not receiving nice even amounts of cash every month, and the cash we receive isn't always in step with the progress on the job site. We're going to be putting in progress claims at certain stages, and the bank isn't going to pay us until we sign off on that stage. And so that means that the payments are lumpy, but we need a way to track our progress on the job so that our books or the balance sheet and our profit and loss reflect the reality of the job site. And that missing piece there is our work in progress calculation, okay? So if you think about it, this is a bit of a simplified example, but let's just say, for example, we've spent $50,000 on a job so far, labor, materials, trades, but we've only put in a $30,000 progress claim. So there's a $20,000 difference that, that's really our work in progress. A bit of a simplified example, but that difference there, we're not just 20 grand in the hole, it's actually an asset that we've built or are building, and we need to reflect that in the books. Because otherwise you're just showing a big loss and no asset, okay? And we can have positive or negative WIP. That doesn't necessarily mean good or bad. It's just thinking about, all right, are the payments or the cash that we're receiving for this job, is that ahead of the actual progress on site, or is that behind the actual progress on site? Often it will be behind. In some cases, it might be in front. I'm going to go through an example of this, but first of all, why should you care as business owners about calculating this figure and knowing this figure? First of all, it is going to be a critical component for you to meet your minimum financial requirements under these new laws. So we want to be on top of this for that reason. And look, this is the piece that makes your profit and loss make sense, makes your financials make sense. It allows you to track your progress per job and your margin per job. If you need to borrow money, either for the business or outside of the business, we need to produce some financial statements to go and buy that property or grow the business. The banks will love you if we get this right. They'll look at your numbers and they'll have a lot of confidence in you. Okay, so the framework there is everything. Now let's go through a simple example of what this is and how it works. So we're a home builder here. We've got 3 projects on the go. And let's just break these down one by one. Project 1, let's just say maybe we're building a granny flat or a second dwelling for someone. And let's say the total contract value is $430, $430K. And that's excluding GST. All right, all these numbers are excluding GST. Our budgeted cost, $335. And so our expected profit there is $95,000, or our gross profit margin of 22%. Now, where are we up to date? What progress? What stage of the job are we at? Progress, we've put in progress claims or invoices of $200,000. So if we think about that $200,000 as a percentage of our total contract value, we've put in 47% of the claims, so just about half. If we think about the costs incurred, $260,000, again, as a percentage of our total costs, that's just under 80%. So you can see here, if we think about this, is cash ahead or behind costs? Our cash is lagging behind our costs. Our costs are at 78% of total, and our cash is only at 47%, which is pretty typical on most builds. And so what we want to do there is our WIP adjustment at the end of the month. We want to say, all right, if we're 31% behind, our cash or our progress claims are 31% behind the actual on-site progress of the job, let's put in an accounting adjustment to recognize that progress. And so in this case, we've got $133,000 worth of WIP there. And there's a twofold impact of this. Doing this accounting entry will increase our revenue by $133,000. So we're recognizing in the books that we've done this work, but we just haven't sent the claim yet. And on the flip side of that, it's recognizing that represents an asset. So we're going to put that extra $133,000 on our balance sheet as an asset. Okay, so that's a positive WIP adjustment. Project 2 is an example of a negative WIP adjustment. Let's just say we're doing a little renovation. Total contract is $80,000, costs are $50,000, and our gross profit is $30,000, or a 38% margin. Smaller job, higher margin. Again, depending on what sort of work you're doing, your margins are going to, be within this sort of, some sort of range. But again, it's going to depend on what sort of work you're doing. Now, let's say we've put in progress claims of $30,000, which of the total 80 represents 38%. But we've only incurred $10,000 worth of costs on materials and trades so far. So we haven't spent too much money. We've only spent 20% of the total $50,000. And so in this case, cash is actually ahead of costs. And so we would want to do a negative WIP adjustment of $14,000. A good way to think about this one is that our customer has paid us money. It's sitting in our bank account, but it's not actually ours yet because we haven't done the work associated with it yet. We're almost holding it until we do that work. And so in this case, we would just be doing a small negative adjustment. Not as common, but it does happen. And then project 3, we might be doing a home build there. If we look at these numbers here, we've put in progress claims of $650. which is 76% of the total being 850. Our costs incurred are also 650, but they're a much higher percentage. They are 93% of our total costs. So we've almost incurred all the costs of the project, but we're still lagging behind in revenue. And so here we're doing a 16% positive WIP adjustment to recognize an extra $139,000 worth of WIP asset. And so at the end of the month, we're going to do our total here, and that is $259,000 worth of WIP asset that we're recognizing on the balance sheet, and an extra $259,000 worth of revenue on the profit and loss. And so this is very, very often, this is the missing piece that ties all your financials together, so they make sense for us and for the regulator and for the banks. So multiple purposes. Okay, now I'm just going to jump into Excel and show you a live example of how this works. So here we've got an example income statement, which is the same as a profit and loss, just two different names for the same thing. And I'm just going to delete out our WIP adjustments for now. And this is typically what you might see if you ran a profit and loss out of zero. So I've just simplified it. In reality, your profit and loss is going to be a bit longer. But let's look here. We've got 5 months across the top. And down the column, we've got sales, 115. We've got materials, subcontractors, plant and equipment hire, and then our direct wages and super. So these are all our direct cost, or our COGS, our cost of goods sold. You might be familiar with them under that name. And that gets us down to our gross profit for the month. In this case, it's a loss, showing as a loss in April. Now, there are other overhead costs that sit below this: vehicles, admin costs, accounting fees, insurances, etc. Right now, we're just looking at the gross profit, which is our revenue minus our direct costs that directly relate to that project. Now, if you just ran a profit and loss out of zero, you might see something similar to this, where our revenue is very lumpy because, again, progress claims come in at uneven times. We've got smaller months and then bigger months, you know, $90,000 and then $430,000. So it's very up and down in terms of revenue, which means that our gross profit is also very up and down depending on when those claims go out. So here, you know, you've got a loss, a big profit, big loss, big profit, little loss, and our gross margins as well are just all over the place. And if we look at a graph of our gross profit, you can see here, it's like a yo-yo. Very hard to analyze, very hard to gain any insights as to how we're performing, and also very hard for the regulator, well, for us to show the regulator that we're doing well. And so if we put in our WIP figures here, which, you know, that is an opening WIP figure. So at the start of the month, what was our work in progress? At the end of the month, what was our work in progress? And the difference here is going to be our WIP adjustment. You can see instantly what's happened to this chart here. And also across the bottom here, all of a sudden our gross profit is nice and makes sense. And our margins probably make sense as well. And we can now track those margins. Same with our chart here. You can see, yes, it fluctuates. It's always going to fluctuate. But we're showing positive profits every month. And the regulator and the bank are going to be happy with that. But we can also use that to really improve our business. That's a pretty visible impact on how that works. You might know the other key, so our income statement is one of the key financial statements. The other one is our balance sheet. And again, I'm just going to delete out that WIP asset to show you what it might look like if we ran one straight from zero. So let's just think about a typical balance sheet. We've got cash in the bank, $90,000. We've got $89,000 owed to us in outstanding invoices or progress claims. Our WIP is missing, and there are current assets, okay? Non-current assets might be our plant and equipment, that might be vehicles, other bits of gear. So we've got total assets, $329,000. In terms of our current liabilities, we've got $142,000 that we owe in materials or trades. We've got some GST payable. The BAS hasn't rolled around yet, so we've got to pay that BAS. And we've got pay-as-you-go withholding on our wages as well. That's part of your BAS as well. So current liabilities, $240,000. And then we might have some longer term debt. That might be a business loan, it might be vehicle loans or equipment loans. We've got another $120 there, meaning our total liabilities, 360. And so we think about these, those minimum financial requirements that we kicked off with. The first one is the current ratio test. And again, that's comparing our current assets and our current liabilities. This horizontal line here, that's our minimum of 1. We have to be above that to keep our license. And you can see here at present, we're actually below it. Then we come up and then we get very close here in sort of danger territory, and then we kind of make a bit of a recovery. But it's a very up and down chart. Same with our net assets. Here we're comparing our total assets and our total liabilities, or the net of those two. And in this example here, I'm saying, all right, we are a business turning over $3 million, so our license is for $3 million. And to satisfy that, we need to keep 150,000 of net tangible assets at all times on our balance sheet. If we look at our chart here, we failed this test on multiple points. First month here, what you can't even see, we're actually off the bottom in the negative. We kind of, we touch it back there, we're under, and then we're back over again when we get there. But if we showed that to the regulator, that would, alarm bells ringing. They might come in and do a further audit. They might even, suspend your license, which obviously, that's your livelihood, that's your business. We do not want them even coming anywhere near that. And so if we put in our WIP asset, which will match back up to the closing WIP on our income statement. We're now showing the value of all that work that we've done as a current asset. And you can see here, look, it's night and day. Looking at that current ratio, we're always above 1, nice steady trend here. It's not all over the place, nice and steady. Same with our net tangible assets. We're always maintaining that minimum. Maybe we just applied for our license here and then we're staying above that minimum. In reality, your line's probably not going to be looking like that, but as long as it's nice and steady and we can show the trend and it's not up and down. So hopefully that gives you a little visualization of the value that doing this does with the regulator. All right, let's go back to our presentation. Another way to think about WIP is, and I like thinking about it like this actually as well, it's thinking about this cash cycle, or your accountant might call this the working capital cycle. And it's thinking, all right, as builders, what do we actually do? Okay, we take some materials, some labor, we take a set of plans, we organize our trades, and it's often a lot of headache, and maybe on certain jobs there's blood, sweat and tears as well that go into that job. But we take all those inputs and we build a building. And in this case, until we finish that building, it's work in progress. It's a half-finished building. And so that is what we've produced. Once we get to a certain progress claim, we're going to be sending out our progress claim or our invoice, and we're going to be converting that WIP asset into an accounts receivable asset. And then when we finally get paid, that's the aim of the game, is to get some cash. So that turns into cash, and hopefully there's some profit in there that we're going to take home and grow our wealth with and have a bit of fun, and then roll the rest of that cash into the next project. And that's the cash cycle for a job. And it's just the key point here is that at every stage along the chain, we do have an asset. It changes form, and so we've just got to be able to get that on our balance sheet. And that's that key question there. Can we show this on our balance sheet? How do we show that? And so for the first one here, the WIP schedule is the most complicated piece of the puzzle that often people won't do until maybe year end, or maybe their accountant will just make an estimate for them. That's the bit I really want to get us doing. How do we get our accounts receivable on there? That's our APAR, accounts payable and accounts receivable. I'll go through that in a minute. And then our cash, that's the easiest one. That's our bank rec. Okay, you'd be familiar with doing that in Xero, hopefully. We're going to show that our statement matches up with Xero, and that's how we show that asset on the balance sheet. So that's a good alternative way of thinking about it. And that brings us to our next piece of the puzzle, is how do we put this all together? And I think for me, it's implementing what I call a month-end process. So that's what it's known as. At the end of the month, we take a day or two to close off the current month, make sure our figures are correct, and do a bit of a comparison to budget or to our plans or to our goals, and say, how did we go? And there's a few steps here, and I like implementing a little formal process to get this done. Okay, it sounds like a lot, but you might just get this done in a few hours or maybe one day. And if you're a business owner, you spend 1 day per month. That's 12 days a year working on the financial health of your business. I think that's not too much. You've got to be working on these things. Sometimes you got to step out of working in the business and work on the business. And again, you as business owner, you're not the person that has to do all of this. You might have a bookkeeper, you might have your better half doing some. We might, we give you the plan and the program, but we don't just leave you to it. We can do all sorts of steps for you as well. We might do the whole lot for you. We might do certain elements that you need help with, and you might do other elements. But let's just go through this quickly. The first element is the bank rec. You want to be doing this weekly in Xero, and we're reconciling off our income and our expenses in our bank account. At the end of the month, we want to be doing a quick formal check saying, all right, our NAB statement says we've got $100,000. Our Xero says we've got $100,000. They reconcile, we don't have problems, okay? And you might have 3 business bank accounts and a credit card. First thing we want to do, make sure they all reconcile and all the transactions are allocated. The next component there is AP/AR, so accounts payable, accounts receivable. Two sides to this. First of all, it's that we've got all our progress claims and our invoices in the system, sent out to our customers. They're all in there recorded. And then the flip side of that is all our bills that we have to pay are also in the system. So we don't have a pile of bills sitting on the top drawer of the desk that we haven't paid yet. We actually get them in the system so that they're showing as costs and they're showing as payables. And that way, again, we can track our profit much, much better. If we're using a system like Dext, this should be very easy. And then the second part there is, all right, are there anything overdue or getting old or getting late? If customers or progress claims haven't come in, do we have a system in place to chase them? The day it's due, maybe we send them a nice friendly reminder. We do some follow-up calls if anything's late, and then same with our payables, make sure we're not missing any bills that we have to pay to our suppliers or subcontractors. The next step there, super and payroll. Make sure our wages are done and dusted. Make sure the super is also all filed away. Coming in from July is also payday super. So you may not be aware, but moving forward, the laws are changing so that instead of paying our super quarterly, we actually have to pay it every time we pay our staff. So that might be weekly. We're gonna have to start paying super, which is good for our employees, but it's also another strain on the cash flow. It might help us manage it a bit better, but it also means that cash isn't available for other uses. We have to pay it straight away. So that's another one we're going to have to be very mindful of. This next one here, accruals. A lot of small and medium businesses won't be doing this, and that's fine in a lot of cases, but in this element, I really do like to think about it. And what I mean by this is, here's a good example. We've got a subcontractor, they've done 20 grand worth of electrical work for us, but they've been busy or slack and they haven't actually sent us the bill, but we know they've done the work. We could accrue it by basically putting in an accounting entry to pick up that $20,000 expense and the $20,000 bill that we're going to have to pay because we know that it's coming. And that way our profit and loss is going to be way more accurate, and then we might get the bill from them next week or next month, and we reconcile it then. So this is key for sort of big items that move the needle. Your big materials, your big subcontractors, but you're never going to bother doing this for your $100 phone bill. Okay, it's just the ones that are going to make a difference. So significant items only. Now your next piece of the puzzle is the WIP schedule. I will do another webinar going over actually how to do that schedule. That's going to take into account our original contract value, any variations that have been signed off, and then our costs to date, plus if there's overruns or extra costs that we are now aware of that we weren't originally. It's going to factor in all those adjustments, and it's going to get our WIP figure ready to put into our financial statements. Last piece of the puzzle there, what I call variance analysis. Look, it doesn't have to be rocket science. We're just looking, all right, what was the plan for this job and for this month, and how did we actually compare? All right, were we ahead of costs? Were we, did we run over on certain jobs? What went wrong? And where did we win? What went right? And that's a great way to track our progress and improve our business. So it doesn't have to be fancy and complex. It can be pretty simple, depending on how crazy we want to go. All right, and look, this is the real opportunity that I see. The laws that are coming in, these minimum financial requirements, they're almost forcing our hand. But let's look at it as an opportunity to level up, to do what the pros do, to set some goals, to improve our margins in our business. And ultimately, look, we're all doing this for a different reason. Whatever your reason is, we all want a better business and a better life. And I think this framework is a great way to move towards that. Now, some practical steps just to finish up with. I'll have you out of here in a couple of minutes. First and foremost, know your turnover and the required net tangible assets to support that. We've got a bit of time, start thinking about, all right, if am I going to be below that $1 million threshold? Might be a bit easier for us. If we're a $2 million business, but we want to be a $4 million business, let's know our figures so that we can work towards them. Next, do you have a proper asset register? Does it reconcile on your balance sheet? So, you might know in the shed you've got vehicles and plant and equipment and all sorts of bits of gear, but are they actually showing accurately on your balance sheet? A lot of financial statements are prepared for tax purposes, and as you would know, often those bits of equipment we can just write off for tax purposes. So they might have just been depreciated straight off of your balance sheet, but for these tests, we're going to want to show the value of our assets, and sometimes that might be at book value. We might bring in a market value to get that asset showing to the regulator. How do we measure our WIP? Covered off on that. Beware of shareholder loans. So if you print a balance sheet off of zero, it might say, you've got 200 grand worth of shareholder loans. You might have heard your accountant sort of grumbling on about Division 7A. It is a very big, important issue, and that's essentially where you've taken cash out of the business. You've had a great year. You pulled out 100 grand to go and buy a property or go on holidays or do something. Often that might be showing on your balance sheet as an asset, but in the case of these minimum financial requirements, we're not going to be able to include it. Only in very rare circumstances are we going to be able to use that as an asset, and so typically it's going to be excluded, and we need to put some thought into managing that. Trading trusts, if you're trading out of a trust, review your structure. You might have to move to a company as part of this. New builders, have a think about, and definitely talk to your accountant. If you're going to go and set up a new company, a new building business, think about how to set it up. Often we would just issue a few dollars worth of shares and you would lend in money to fund the business and get started. With these new rules, we might have to think about issuing some more shares so that we've got a nice base level of assets to tick the box with the regulator. Come and talk to us about that one as well. And then look, get in touch to put some structure around your numbers. Just a little bit about me and my business. I've recently relocated down here to Victoria, looking to work with builders who are keen to take control and put some structure around their numbers and really kick some goals. You are not alone with these changes. They might seem daunting and challenging and scary. You're not alone. We are here to help. Get in touch, and I look forward to speaking with some of you. Thank you so much for your time. I hope this was of great value to you guys. Thanks. Bye.